Hello class, we are going to look at inventory, and in this chapter we look at inventory and we talk about the difference between the periodic inventory method and the perpetual inventory method, and then we are going to look at the journal entries to record inventory using both methods. So the first thing that I want you to see is the way inventory works. So inventory is kind of a closed loop system, meaning all of the costs have to be just a couple of places. So if you picture, you walk in at the beginning of the year and you look at the inventory that you have in stock. That's your beginning inventory. So on the first of the year, that's everything that you have available to sell. Then during the year, you're making purchases. So if you take your beginning inventory plus your purchases, that gives you all of the merchandise that was available to sell that whole year. Everything that was available to sell has to end up one of two places. Either it's still going to be an ending inventory because you didn't sell it, or it's going to go to cost of goods sold because you did sell it. So you have your beginning inventory plus your purchases gives you all of your merchandise available for sale. And then that ends up either on the balance sheet in ending inventory or on the income statement in cost of goods sold. There's two different inventory methods. One is perpetual and one is periodic. And we use perpetual a lot more now than we used to because you have to have a barcoding system for perpetual. With the perpetual inventory system, what you need to think about with the journal entries is that everything goes directly into the inventory account and everything comes directly out of the inventory account. So if we were going to do journal entries for a perpetual inventory system for buying and selling inventory, this is what it would look like. So let's say that we purchased $500 worth of merchandise inventory for cash. We're going to put it directly into our inventory account. So we're going to debit merchandise inventory. It's an asset on the balance sheet. So we increase merchandise inventory and we decrease cash. So now we have this $500 worth of inventory on our balance sheet. Now let's talk about credit terms. So when we pay for that inventory, sometimes we'll pay the full amount, but sometimes you'll have an invoice that'll say like $210 net 30, or $215 net 30, or $310 net 45. So what that means is the seller is giving a discount for paying more quickly. And the reason they would do this is to improve their cash flows. So like $210 net 30, the 2 is the amount of the discount and 10 is the number of days. So if you pay within 10 days, you take a 2% discount. But no matter what, everything is due within 30 days. So it doesn't have to be 210, it could be 315, but the first number is always the discount amount, the percentage, and the second number is always the number of days. So we purchased that $500 worth of merchandise. Now we're going to purchase it on credit. And the terms are $210 net 30. So on November 2nd, we bought merchandise inventory and they're going to invoice us. We're going to pay it later. Now, if we pay within 10 days, we get a 2% discount. We're not going to worry about that. So now we're going to pay. So we're paying it within the discount period. So you're going to say, okay, so how much is my discount? You can do this two ways. You can either say 500 times 98% is what I'm going to pay, or you can say 500 times 2% is my discount. But here's the trick. The trick is how much is in our accounts payable account right now? What did we put in our accounts payable account? We put $500 into accounts payable. When we're done paying this, we're going to send them a check for $490 because we're taking the 2% discount. So we're going to write them a check for $490. But what you have to think about is how much do we owe them? On our books, we owe them $500. After we make this payment, how much are we going to owe them? After we make this payment, we're not going to owe them anything. So you're going to have to take the $500 out of accounts payable. So we're going to debit accounts payable the full $500. We can't leave anything in there because we don't owe them anything more. You're going to credit cash for the $490, which is what we're writing the check for. And the $10 gets deducted from merchandise inventory. Because it's kind of like, well, we didn't really pay $500 for the inventory, we really paid $490. So that's what you're going to do. You're going to take the difference, the discount, out of merchandise inventory. So this is what it looks like. We started with $500 in merchandise inventory. We subtracted 10, so now we have 490. So on our balance sheet, we have $490 in merchandise inventory. In accounts payable, we started with 500. We know we need 0, so we took the entire 500 out, and we reduced our cash for the amount of the check, 490. Let's say that we didn't pay it within the discount period. Let's say that we waited until after the discount period and then we paid it. Well, this is not a new entry. This is something you've already done before. So we debited accounts payable for the $500 to make it go away, make it 0, and we credited cash. This is not new. All right, now let's say that we have a purchase and then we're looking at returns and allowances. So when we when we sell inventory, right, we have the sale. Sometimes somebody will return inventory. So we want to keep track, if we're the seller, we want to keep track of those returns. So we use a purchase return account. And then purchase allowances is for, let's say a customer gets the product, it's slightly damaged, but they're like, you know what, we can sell it anyway. Would you give us a discount? And so we're like, yes, we'll give you a discount. That's a purchase allowance. So we have purchase returns and purchase allowances. So on our income statement as the seller, we would have sales. Oh, that's sales returns. We're going to have purchases less purchase returns and purchase allowances. So let's say that on November 5th, the buyer issues a $30 debit memo for an allowance because of defective merchandise. So what happened was, remember, we bought that $500 worth of merchandise and it comes in, we're unpacking it, we're like, oh, this is defective, but I think we can still sell it. So we contact the person we bought it from and they say, you know what, we'll give you a $30 credit. Okay, so what we know is we had $500 in accounts payable. They just gave us a credit. So since they gave us a credit, we're not going to pay it. So we're going to reduce accounts payable by $30. Because this is the perpetual method, we're going to directly reduce the merchandise inventory for $30. So we're going to take this credit and reduce accounts payable and reduce merchandise inventory. Purchase returns work the same way. So here we purchased $250 worth of merchandise on June 1st with terms 210 net 60. So this is the purchase. We purchased merchandise inventory and we credited accounts payable because we're going to pay for it later. On June 3rd, Z-Mart, we returned $50 worth of goods before paying the invoice. So they're going to, when we return the goods, we're going to debit accounts payable because for the $50 we returned, we're not going to pay. And we're going to reduce merchandise inventory for the amount of inventory we returned because we don't have it anymore, we returned it. Then we're going to pay on June 11th and take a 2% discount. Okay, so we started with $250 in accounts payable. We reduced it $50 for what we returned. So our new accounts payable balance is $200. A 2% discount is a $4 discount. So we're going to write the check for $196. We have to debit accounts payable for $200 because that's how much we owe. That's how much is in the accounts payable account. We're going to reduce merchandise inventory with the credit for the discount and then our check is $196. Everything comes directly in and out of the inventory account. Okay, the other interesting thing is that with inventory, all of the transportation costs get rolled into the inventory account. And the reason we do that is because we want to match the revenue with the cost of the inventory. So when we sell it, we move all these costs that are in inventory to cost of goods sold. There's two different shipping terms. There's FOB shipping point and FOB destination. The significance of these is primarily who owns the inventory. So with FOB shipping point, when the inventory is shipped, ownership transfers to the buyer. With FOB destination, when the inventory reaches its destination, the ownership is transferred to the buyer. So the whole time it's en route, it's owned by the seller. Usually with FOB shipping point, the buyer pays, and with FOB destination, the seller pays. So let's say that we purchased merchandise on terms FOB shipping point, and we paid $75 for transportation. Now remember, that transportation cost gets included in inventory. So instead of doing anything with the transportation expense, we're going to debit that $75 to inventory. So we're increasing inventory the amount of the transportation costs. So this is what it would look like. We've spent a lot of money on inventory, minus purchase discounts, minus purchase returns and allowances, plus transportation in. Notice that it's called transportation in, sometimes freight in. That's to differentiate it from the transportation cost paid to ship inventory out to the customer. This is when we bring inventory in. And so there's our net cost of our inventory. So I want to skip through here. These are actually good to, because I wanted to show you at the end of the chapter. Didn't do this very well, did I? Okay, so we're going to switch hats now. So everything we've done so far, we have been the purchaser of the inventory. Now we're going to switch hats and we're going to look at what happens when we are the seller. What happens when we sell merchandise inventory? So when we sell inventory, it goes on our income statement. We have sales for whatever revenue we brought in minus cost of goods sold. When we sell, we might be the one offering the cash discount for early payment. So here's what we're going to do. So here we have Z-Mart sold $1,000 worth of merchandise on credit. The merchandise has a cost of $300. That means that when we purchased the merchandise, the inventory, we paid $300. But when we sell it, we're selling it for $1,000. So what's the difference between the $1,000 that we are getting for the inventory and the $300 that we originally paid for the inventory? That's our profit. That's what we're looking at. That's our profit. So when we sell this, we're going to record accounts receivable for the $1,000, and we're going to record sales revenue. That's going to go on our income statement. So on our income statement, we have $1,000 worth of sales revenue, and we have a receivable for $1,000. With the perpetual method, when we make a sale, we do two things. One is we record the sale just like we always have. That entry we just did is like we've been doing. But we also record cost of goods sold. So we're going to record $300 worth of cost of goods sold. And we're going to reduce merchandise inventory by $300. We only do this with the perpetual method. So now on our income statement, we have sales of $1,000 less cost of goods sold of $300. Same sales discounts apply. So let's say that we made this $1,000 credit sale with terms 210 net 45. So we get a 2%, we're giving a 2% discount if our customer pays within 10 days. Everything is due within 45 days. So these first two entries are what we just did. Now let's say they pay within the discount period. They're going to take the $1,000 that they owe us times 98%, means that they're going to write a check for $980. So we're going to receive cash for $980. But we're going to reduce the receivable for $1,000 because when they send us that $980 check, are they going to send us any more checks? No, they've paid us in full. So we have the $980 and then we have the $1,000 that we're reducing. Now, this $20 goes into a special account. When we're the seller, we're going to keep track of sales discounts. And the reason we want to keep track of sales discounts is because we want to be able to see what have we gotten back from sales discounts. So that's what happens if they pay within the discount period. If they pay after the discount period, we're going to debit cash and credit accounts receivable. This is not new. This is what we've been doing for the last 2 weeks. We're going to do the same thing with sales returns and allowances. So let's say that our customer that bought the merchandise for $15, it cost us $9, returned it. We're going to use a special account called sales returns and allowances because as the seller, we want to keep track of what gets returned. That might be good information to know what got returned, how much, why. So we're going to debit sales returns and allowances. Sales returns and allowances is a contra revenue account. That means it has the opposite balance of a revenue account. So on our income statement, we'd have sales, less sales discounts, less sales returns and allowances. So they returned $15 worth. We're going to record sales returns and allowances and give them back the cash. Now, let's say that the merchandise is not defective. We're going to put it back into inventory at our cost, which was $9, and take it out of cost of goods sold, which is where we put it when we sold it. So we're just going to reverse what we did when we sold it. We're going to debit merchandise inventory and credit cost of goods sold. Now, let's say the goods are defective. We can't just put it into inventory that's full value. So we're going to put it into inventory at what we think we can sell it for. So we'll put it into merchandise inventory at $2 in this case. We're going to record a loss from defective merchandise and then put the $9, take the $9 back out of cost of goods sold. Okay, so I'm going to post this and then tomorrow I will work through some problems from the practice problems for the first group of practice problems.